Hi, everyone, and welcome to another Meyer Capital Group video installment. I'm Tom Meyer Jr., joined as always with Chris Paleologus. And today we're going to talk about something that's been dominating the news headlines, the debt ceiling. We're going to go over what it is, the history behind the debt ceiling, and what it means for the markets in your portfolio. So to start, what is the debt ceiling? In the United States, the debt ceiling or debt limit is a legislative limit on the amount of national debt that can be incurred by the U.S. Treasury, thus limiting how much money the federal government may pay on the debt it already borrowed by borrowing more money. In fact, the U.S. reached its debt limit of $31.4 trillion on January 19th and has since been relying on funds in the Treasury General Account, or the TGA, that we'll reference later in this video, and so-called extraordinary measures to fund its obligations. The extraordinary measures include suspending payments to some government employee savings program, underinvesting in certain government funds, and delaying auctions of securities. Another way to think of this, in other words, is raising the debt limit is not about new spending. It is about paying for previous choices policymakers legislated.
Exactly. So now a little history of the debt ceiling. So in 1917, during World War I, Congress created the debt ceiling with the Second Liberty Bond Act of 1917, which allowed the Treasury to issue bonds and take on other debt without specific congressional approval, as long as the total debt fell under the statutory debt limit. Prior to 1917, there was no debt ceiling. So between 1788 and 1917, Congress would authorize each bond issued by the United States Treasury by passing a legislative act that approved the issue and the amount. So you can only imagine how that process would work in today's environment.
Yeah, not the most efficient, that's for sure. Talking about that, how many times have we raised the debt ceiling? So Congress has raised the debt ceiling 78 separate times. And including suspensions, lawmakers have raised or suspended the debt ceiling over 100 times since World War II and under every president since 1959. The national debt, as expressed in absolute dollars, has increased under every presidential administration since Herbert Hoover.
So what are some alternative options that are being discussed? One option is invoking the 14th Amendment, which, among other things, states that the validity of the U.S. debt shall not be questioned, but that is highly subject to legal interpretation and would most likely get tied up in courts. Another option is that debt payments could be prioritized, although it's unclear that operationally the systems and procedures in place are equipped for this. So basically that would mean paying the debt holders first over Social Security payments or federal employees, et cetera. Finally, the Treasury could issue and deposit $1 trillion coin at the Fed in exchange for funds in the Treasury General Account, the TGA that Tom spoke about earlier. This proposal, though, has largely been dismissed by central bankers, and therefore the path of least resistance is suspending or raising the debt ceiling.
So what happens if we don't raise the debt ceiling? So in simple terms, if the government can't borrow to help pay for all of its bills that come due, it would have to suspend certain pension payments due for Social Security recipients, to Medicare or Medicare providers, withhold or cut the pay of soldiers and federal workers, or delay interest payments, which would constitute default. Essentially, it would hamstring the government's ability to finance its operations. It would also depend on how long it lasts. The longer an impasse, the more damage would most likely be done.
So this next part is for the history buffs out there. So has the U.S. ever defaulted on its debt before? And while the answer to Treasury bills and Treasury bonds, the answer is emphatically no. There have been 4 other examples of default in the U.S. history. So in early 1862, the U.S. government defaulted on demand notes caused by the Treasury's financial difficulties trying to pay for the Civil War. In 1933, the U.S. government defaulted on gold bonds. In 1968, the government defaulted by refusing to honor its explicit promise to redeem silver certificate paper dollar for silver dollars. And not too long ago, in 1971, the U.S. government defaulted on its commitment to redeem dollars held by the foreign governments for gold under the Bretton Woods Agreement.
So with all this said, what is the most likely outcome? The deadline for something to pass seems to be June 1st. Janet Yellen has said that's when the extraordinary measures we spoke on may run out. And we can all speculate about what will happen. But if history is an indicator, usually these things will get down to the 11th hour and then something will usually pass. So you're going to see, we're going to put up a picture of a calendar here, and it shows the days that the House, Senate, and Biden are all available. All three are available to meet until May 17th, which is highlighted in green. And this is when a deal is most likely to be reached. And if no agreement is made by May 17th, they won't all be available for the rest of the month, thus most likely slowing down negotiations, bringing us to that 11th hour. And if there's no steadfast agreement, there may be a shorter term debt limit raise that kicks the can down the road for a bit longer. We've seen this before, but only time will tell what happens.
Yeah, and the best point of comparison as far as to what to look out for the markets is the 2011 debt ceiling standoff and subsequent credit rating downgrade. So we'll put a chart up in here that shows equity prices and also treasury yields. So interestingly, during that time period, treasury yields actually fell while equity prices also fell. When you're going through a debt rating downgrade, that means that the debt is riskier, and therefore investors would charge a higher yield to invest in that riskier debt. But yields actually dropped 120 basis points 1 month before the debt ceiling agreement and over 1 month following the debt downgrade. And this is most likely due to the flight to quality that we would most likely see if something like that was to happen again today. Importantly, there are no cross defaults of treasuries. So even if there was a default, only the treasuries that mature when the government runs out of money would default. So this is why many money market funds and other short-term bond funds have avoided T-bills that mature around that June 1st date to help manage risk. So basically, although the date at which the U.S. is set to breach the debt limit is rapidly approaching, we think a short-term deal is achievable to kick the can modestly down the road, buying more time for political negotiations. Although political grandstanding is good for polling and heading into what is sure to be a very contentious election cycle, a U.S. default really serves no purpose at all. The current debate is highly political and centers around government spending and the budget. Republicans want to combine the debt limit debate and broader discussions around budget cuts. Democrats in the White House want the debt limit raised separately, called a clean debt limit raise, and a separate discussion on budget cuts to follow. Unfortunately, this won't be the last time the debt ceiling needs to be addressed. And while the immediate impact would be felt in the stock market, we have yet to really see any dramatic increase in volatility. If we were to see a move lower in stocks as we approach the deadline, we are comfortable with the current asset allocation and strategic long-term goals and objectives of your portfolio. But if you have any questions or comments, please feel free to reach out to your portfolio manager. And as always, thanks again for watching, and don't forget to like and subscribe for more video content.
Thanks, everyone.
Thanks.